special guest that could be joining us here momentarily. To give you a little hint, I'm actually at his house right now, so he's just getting stuff set up in the bedroom. But guys, why don't you go ahead and shoot the questions into the live chat feed. I know with StreamYard that's a little lagged, but when you ask a question, please do me a favor and start the comment with the word question, all in capital letters, so I can see it there. And then we'll make sure that we're getting to them as quickly as we can. And guys, if you can do me a favor also and just send me a comment that says if you can hear the audio and the video is coming through okay. Looks like we're getting people on the live stream now, but this chat, of course, is lagging behind. Well, let's see. I'm not seeing the chat. Hopefully this is... Let me see if I can see them on YouTube. Okay. So I had to flip over to YouTube, guys. Sorry about that. Okay. It looks like I can see all of the chats on YouTube. So I'll go back and forth between StreamYard and YouTube. I think that's the best option right now. So hopefully I can see the chat now, guys. Can you hear me and see me? Is everything looking good? Hear you well? Okay, very good. Awesome. All good. Great. Then we'll go ahead and start. Sorry for the technical difficulty, guys. Let me get my my buddy on here real quick. He's going to add some serious value. There we go. Mr. Hugh Hendry himself. Thank you, sir, for joining us on this live stream, and thanks for being so hospitable. And let me come to your amazing place here in St. Bart's. I'm going to have to give everyone a visual tour here in a minute. We can see the ocean, and we got a pool out here. Just fantastic. But let's get into these questions. I'm sure people want to ask you a ton of things, Hugh, so let me go over and see what we got. All right. Okay, guys, make sure we're starting with the word question. Everyone's saying hello, Hugh, by the way. Hugh and I can't see the live stream, so I'll have to tell Hugh what everyone is saying. Question.
Well, I should say hi to everyone. I'd like to welcome you all to St. Bart's. And of course, island life is only made better when friends visit. So it's an open invitation.
It is. You guys, if you're looking for a place to come and just enjoy some freedom and some fantastic people that you can really learn from, definitely try to check out St. Bart's. I know it's easier said than done right now for sure. All right, here's a question for Hugh. Let's start with that. How were you able to get a loan in St. Bart's for your property? Atlas asks that.
Repeat the question. How was I?
How were you able to get a loan in St. Bart's?
Oh, a loan. Okay, that's a great question because it's very difficult. The international banking sector does not recognize land in St. Bart's as collateral. So if you were to buy land or an existing property, and let's say it's $5 million, typically the bank would would take that in title as the security, as the collateral, and then extend the loan. That typically doesn't happen unless you can liaise successfully with one of the local banks, local French banks. There are no more than, I think no more than 3 banks. There are more than 3, but several actually come under the same ownership umbrella of some of the large Parisian-based banks. So you have to really be able to communicate in French. I can just. You have to have some kind of commercial arrangement with the island, or connection with the island, and then of course you have to establish your means. And typically just now they are looking for anywhere between typically about 30% equity that you have to provide also. Now thereafter, it's a securitized loan, and you can, depending on your age, but I am 51 and I secured a 20-year mortgage. I paid quite a high rate. I was purchasing the property that we're in now is my second property, and it finds itself immediately in front of Maison Blanc Bleu, which has this 180-degree incredible sea view. And so regardless of whatever I paid for the property in front, I would always get it back through the appreciation in value by having the rights to that view in perpetuity. Long story short, I paid about 2% for 20-year money. I think that rate now is closer to 1.
Yeah, but relatively speaking, I mean, that is some cheap money.
That's, it's cheap, but I was kind of tweeting, I think, this week and saying modern life is rubbish. And what I meant by that is, what's the point of cheap money? What's the point of quantitative easing? What's the point of getting a 20-year loan for 1% if we still have to do the, what is the term? We have to do the capital repayment, because even with 20 years, that is, you're paying 5%. So in terms of your cash flow yield, even at a 1% interest rate, your cash flow negative yield is 6%. And that's a challenge. To seek commercial returns on building up ultra luxury villas on the island today, you really have to be committing risk like equity plus debt of between 10 and $15 million. So that times 6% is hard. So again, I just think that there's some easy things that we could do. Why can't we encourage the banks again via more benevolent capital regulation, which would favor interest only or bullet loans? Because there's 2 things going on. With having to repay, I don't want to repay capital. The money is cheap, to paraphrase you. You said, the money is cheap. It's cheap. I want to pay it all back in 20 years' time. I don't want to pay 5% back this year. I want to pay it all back in 20 years' time, because I'm going to be paying nothing, So, but the banks and the need to set aside capital against that kind of transaction is very boring. But like we know, in 20 years' time, the capital bar is going to be way higher than it is today. But anyway, I digress. There you go. I want to say there's no more than like 100 people in the world, perhaps, who are kind of French, can speak French, have a relationship with the bank, have access to money, and then understand the kind of, not chaotic, but the kind of Byzantine process for seeking a permit application. And it can take up to 3 years from buying, securing, and seeking either modification or to knock down and rebuild. So it's a substantial undertaking that's not for the many.
Yeah, and that's why real estate is so inefficient compared to another market such as gold. And what's very interesting, guys, is Hugh's rationale for making this bet, if you can call it that, putting it into macro terms. It was really it was a macroeconomic play to go long volatility and to take out cheap debt to do that. But I'm going to be interviewing Hugh later on in the week, and we're going to make it an official, formal interview where I'm really going to try to dissect his rationale, so you can take his thought process and why he went long volatility with real estate here in St. Bart's, and take the concept and apply it to your own circumstances wherever you are in the world. And I think it's what he's done here in St. Bart's is applicable to rural property in Arizona or several places in the United States. It doesn't matter really where you are if you understand the concepts. So moving on to the next question here, Hugh, I've got one that I'm actually curious to hear your answer. And this chat moved on me. Let me see if I can find it here. Here we go. What, and you just had, for those of the viewers who are on right now that might not realize this, you just interviewed Richard Werner for Real Vision. I say just, probably about a month ago or so. So this question is, what aspects of Richard Werner's work theory are you not convinced by, and why?
Do you know, remarkably, as you brought that question up, I'm looking at my other screen and I woke up. I am becoming a little bit obsessed with this damn Twitter. It's so cool. It's like playing. I'm playing chess with great minds like Richard Werner, and
Yeah,
he entered the lines then yesterday with some provocative kind of slaps in the face, if you will, and that's Richard.
So you're going back and forth with Luke Groman, and I guess Werner chimed in there, didn't he?
Luke, analytically, and the work. Well, first and foremost, I respect Luke.
Yeah.
And then on top of that, analytically and the product that he produces, and it's largely chart based, but his record of interpreting that data has been excellent. But I really get upset at Luke's interpretation of economic history with things like the dollar standard. I know you were whiteboarding that, and with the events surrounding the closure of the dollar gold window by Richard Nixon in 1971, and I get inflamed way too easily. I've got to take my chill pills.
I think everybody does, though.
And I'm saying your Saturday's kind of beach day, where we are, like the Caribbean in the summer is just damn hot, not just hot. Not Arizona's hot. This place is humid hot, you know.
Yeah.
And there's a great sea breeze, and so we had a picnic on the beach yesterday, and I just sat there. Anyway, Richard Werner, I woke up this morning, and the great professor, he's come back again, and I had, just as I was waiting for you, I had written a retort, and I just damn lost it. So he was saying, hey, you know, by establishing a dollar-centered monetary system operated by US-controlled IMF, the Americans could just go out into the world and buy anything. And okay, deep breath. What I object to that is there's a presumption that just by the stroke of a pen that one creates, what did he call it? A dollar-centered monetary system. And that inflames a rage deep within me because it's to ignore. We have a dollar-based system today, following the fruits and the endeavors and the hard work of the many who've striven for over 100 years, and they have typically got it more right than wrong. Their success record is far from perfect, but it's a bit like being a hedge fund manager. If you're just like kind of 0.5555% more right than wrong, and I think the batting swing or whatever for the US is certainly not 0.555. I think it's way higher than that. It's the only reason why there are lines outside American embassies and world capitals. It's the only country, it's the only culture that people are queuing to get in. And really owing to the security of money, yes, we have great problems with the political economy, but we exaggerate it. It's noise. You know, I listened to Warren Buffett the other day, and one of his great points that over his 76, he's now been investing for 77 years, and he's had 7 Republican presidents and 7 Democrats. I think someone told me he probably made more money during the Democrats, whatever. There's a yin and the yang, and the damn thing works. And so not only are people forming lines and kind of asking to get in, but foreigners and their wealth, the one place they feel secure in parking that wealth is in the United States of America. So that's kind of what I will be going back to Richard with later on.
Yeah, I would, I don't agree with that fully. I would agree with that if you took a snapshot of the world as it is today and assume that that's the way it's going to be on a moving forward basis indefinitely. And I just came from the States, and I can tell you what's going on there. I would not want to put capital to work right now based on the trajectory that I think the United States is going. Now, of course, back to your point, you got to say compared to what? What else are you going to do with it? And if you've got 10 billion of dollars to put to work, you're not going to be able to do that in a place like Colombia or St. Bart or something like that. So there is that question and what level or what amount of money you're investing. But I think that, I look at countries as having a brand, like a Coca-Cola or a Procter and Gamble or a Chevron or Ford or Tesla or something like that. And I think that the United States was able to build the best brand by far in the entire world when they, post Bretton Woods, going into the 1960s, the 70s, the 80s, the 90s. It was the U.S. had the best brand, and that takes a long time to turn and go the other direction. It's like a giant ship. Colombia is another example, the complete opposite. They had this brand that if you go there, you're going to get beheaded, you're going to get kidnapped. It's all Pablo Escobar, drugs, all these things. But they're slowly changing their brand because of the internet to where it's much more tourist friendly. To people actually want to go there. And so I just think that maybe, just maybe, the U.S. Has been riding the coattails of the brand that was created by people like the generation of my father and my grandparents back when in Bretton Woods, when the reason we went on the gold or the dollar standard was because we had the most gold. Therefore, by definition, we created the most exports. We were producing more than we consume. And I think that maybe the last 40 years, we've been consuming more than we produce. And although the snapshot right now, I totally agree. I just think, but maybe in the future, it might not be that way. But that's a topic for debate. We got to save that for our interview, Hugh, because that's going to take us another 2 hours, I'm sure. So let's get into another question here. Okay, let's ask. This is a great question, Hugh, and I'd love to love to hear you kind of pick apart my type of strategy, because me just being an amateur, I just try to keep it simple as possible. And this person brings up the question: have you considered changing the percentages of your portfolio to adapt this economic climate? So generally, I like, for my own portfolio, I have 10% allocated to what I call insurance. So that would be physical gold. 10% allocated to speculation, and then 80% allocated to something what I would define as an investment. That means it has to pay me to own it. So a dividend paying stock, real estate, something like that. And that's what I suggest my family members and friends do. So I always tell people that's what I'm doing. Maybe you should think about the same thing. Is that too basic of an approach for the average person, Hugh? Or what would your feedback be on that type of portfolio structure?
I think you're on the right track. I think you want to, at all cost, avoid complicated structures. Keep it simple. I would say I feel like I'm pursuing a lot of what you just described, and I'm doing so kind of subconsciously. I am so inefficient. There's just so much going on inside my head that I need a lot of help with real life. I feel I'd kind of like to be doing more kind of trading for my own account. But the whole thing about setting these damn things up and trading and so I've got a little bit. I think I documented that having kind of re-entered the fray in March of this year, I found I had some cash hanging around, not inconsequential, and if you will, that may represent my 10% or so speculative funds vis-a-vis wealth, and I invested that in the holy trinity of gold. I say the trinity. I mean there is a golden triangle, if you will, that at the most risky would be clearly someone who's exploring and not a producer, and then it'd be followed by junior producers, major producers, and then it would be the gold and silver royalty companies, and then of course the bullion or the ETFs for gold and silver. And I've taken 3 of those. I've taken both the gold and silver. I've taken a bit of the majors in terms of producers, but mostly I've allocated to the junior mines. The junior mines today trade on about I don't think more than about 1.2 times NAV. And I am hoping to release a podcast on my confession series and a video of that on my YouTube page, I hope this week. And there, again, I just described just how explosive gold can be. And maybe if I just take one back up, for instance, I bought Durban Deep, not gloating here.
You turned it off. Sorry, guys, give me 1 second here. I think you accidentally turned off his screen. Oh, there he goes. He's coming back.
I'm back.
All right, Hugh, start. I think you accidentally hit a button there.
I didn't touch anything.
Okay, so it might have been your connection, but we lost like the last 30 seconds of what you said.
Yeah, I gathered that. So I just wanted to explain. There's a term called convexity, and it's just one word, which means that something can move like a skyrocket. And gold has that propensity, and I just wanted to kind of explain why. It's because it's almost like the Black-Scholes options model. Like, how do you value an option? And there are components or variables that you have to be aware of. So clearly in this regard, it's the gold price, but then it's also other people's expectations of what the gold price will trade in 3 months' time, 6 months' time, etc. It's also the rate of change in the price of gold now, and it's also the discounted cash flow. So these guys who are producing, we kind of want to bring forward their future production and give it a monetary value in the here and now in order to look at the net asset value. And then finally, you've got the willingness, almost like a popularity contest, which is the price to NAV. And when you become more popular, the price to asset expands. And so there's, I think I counted 5, maybe 6 variables. And when they come together, boom, okay? So my point was, typically, I am looking for, in terms of this notion of investing and possibly speculatively, I like things which had a bull market. So there's kind of evidence that there was something kind of cool and funky and exciting in that business at some point. Right. And then it had a bear market, which is to say it lost like 80% of its value. It suffered revulsion, rejection. It was ignored. But over the course of years, it rehabilitated itself. And you can see that with these junior mining stocks, the revulsion after the failure for gold to continue or inflation to come through after 2010, 11, 12. Right. People getting out of the sector, these stocks collapsing, going sideways. Long story short, I bought Durban Deep after it had already tripled. I felt more secure. It had to go up 3 times before I wanted to buy it, because I think it then goes up 5 times. And so that kind of can so it can sound a little bit kooky, but there's a kind of rationale there, which is what I was trying to kind of unleash in my description of those variables.
How would that look on a long-term chart, though? Because one of the things I've learned from my good friend Chris McIntosh with the Rebel Capitalist Pro live streams we do is he always says, listen, you've got to look at a 20-year chart to see to get perspective on what the most recent price action has done. So he uses uranium as a good example. If you look at uranium, I bought it back in March. It went from, it's gone up, let's just say 30% or something like that. So you would say, well, should I still buy it after it's had this run? But if you look at a chart of uranium going back to 2008, let's say, or to 2000, you see that it was way up here, and it's just that move of the last call it 3 months is 30% is only this blip on the screen that you can barely see. So it puts things into perspective. Where if you just look at like a 3-month chart, it looks like it might be overbought or something like that. How did you do that with that stock that you're talking about?
I did. I'm so glad you mentioned that. I'm thinking of launching a kind of a stock doctor or island doctor show for people to send in like their kind of best stock ideas and kind of see how they would chart represent it. So my idea would be you get 30 seconds to make a little video to nail it, a bit like Peter Lynch where you had to nail it on the yellow sticky, and then some visual representation. The visual representation the thing that drives me crazy is when people show me three months. 3 months is like 3 months is yesterday. Right. I want to know the lifetime story. So for sure, you said 2008. Uranium peaked around 2008 with the entire commodity structure in general. If you look at a chart of uranium from like 2002, 2003, when I was investing back in the day, again, you have a bull market, an extraordinary bull market. Price movements of maybe 15, 20 times the low, okay? And then from 2008, prices lost 80. Really after, remember the catastrophe in Japan, the Fukushima nuclear incident, followed by Germany coming in and closing down its entire nuclear industry. That led to just a waterfall cascade down in the value of these things. But that was 2012. That was 8 years ago. We've had rehabilitation, and these stocks. So if you think of a huge like V, upside down V, right, and then you come down and where's my finger on the screen, and then it just kind of looks like watching the heartbeat of a patient resting in hospital. So it just kind of does that, and on it flat lines, but the patient is alive. And then the strategy is if you start buying 1 year highs, 2 year highs, 3 year highs, 4 year highs as it breaks out of that range. And really, it's the experience and knowledge of people, of experts that you'll never meet, that you'll never hear about, but you can see the genius of their thoughts. They leave a footprint in the share price, and that's these higher prices as we break out of that 8 or 10 year range of price doldrums. You want to buy and that's where we are with silver. That's where we are with uranium. With uranium, Cameco, the largest miner, it's actually got the stuff. It's mine. I've been down its mines. It's had its ups and its downs, but it's liquid. That's the one I'm envious. I want to buy it. I've just got to get organized, and I'm going to buy it. So you guys buy it before me.
All right. Well, that was great and some incredible insight there, Hugh. I could ask you about another 15 questions about that, but that idea you had about people submitting the 30-second thing, almost like the Dragon's Den or whatever.
Yes.
That's a great idea. We'll talk about that after the live stream. That's a good one. Okay, let's see. Let's get another question here. All right, this might be going back to real estate here. Let's see. Revival 305 asks, what are some metrics used to determine if one should invest in another country real estate if the dollar devalues? Would other currencies devalue more?
Yeah, the dollars is, I believe, most unlikely to devalue alone. The process, if so, there's, again, from my Twitter activity yesterday, the easiest representation of the dollar is the Dixie, the DXY index. Someone came in and actually sent me a much better depiction of that. I can share that with you, George, and you can send it to people. But if we stick with the Dixie, because I've got the numbers in my head, for the last 50 years, the mean has been 100. I want to say today we're not far off 100. We probably we're about 96, 97.
Yeah, right around.
And the wides, which is to say the highs and the lows, would be 130 and 80. I think I am sufficiently concerned about the true underlying state of the economy to assume that the Federal Reserve will be back at its post, making emergency injections to kind of resuscitate an ailing, patient. And so I think the dollar could slide. Why can't in this environment, why can it not kind of gravitate towards that lower position of 80? However, were the dollar to prove to be initially weak against a basket of other stocks and of other countries, forgive me, those other sovereigns would react with lightning speed to devalue their currency. And so, but in doing so, they would have to buy US assets. And I think earlier, if we backed up, you still, I think, there's a saying, I think it comes from Fred Hickey. Is it Fred? Maybe not Fred Hickey, actually. There was a Canadian strategist, forgive me for not knowing his name. But he said that the greatest opportunity, you should write this down, the greatest opportunities come from those areas where those who know it best love it least. Such a great, and when I hear you kind of going about the US brand, I get a lot of that, and when I hear brand sounds like this intangible thing, which again is to kind of ignore the brawn, the ingenuity, the hard work, the persistent strive to improve and get things better, the ability to overcome mistakes. So anyway.
I think that in all my world travels, I think that the American entrepreneur is second to none. I don't think anyone in any country can, if you take an aggregate total of the entrepreneurs in the United States, the real producers that drive the economy forward, create the jobs, I would put them up against anybody. Exactly. My issue is I just think that potentially those people are going to be burdened in the future with more and more and more regulation, with higher and higher taxes that make it very difficult for them to unlock their personal potential and then release all of that savings and investment and job growth in the real economy. And I think they may be, not for sure, but they might look elsewhere to try to achieve their objectives. I think I'm a perfect example of that. I created thousands of jobs in the United States, and since 2012, the only jobs I've created really are outside of the United States, because I just, I didn't like what was going on there, and I didn't like the way that I was being treated. So obviously it's just anecdotal. I'm not saying everyone thinks like I do, but it's just one small example of what I think may happen on a broader scale moving forward. So I definitely don't disagree that the people, the individuals, I think the best way to say it is I'm very bullish on the American individual, and I'm very bearish on the American government and the Fed and this tops-down approach.
And hey, I sound as if I'm kind of go government, go Washington. I'm just trying to gain perspective and just say, is it bad? Yeah, but I'm saying from my experience, like you in living in other quarters of the world, yeah. You know what? Distance gives you context, and they're far worse. Like if we look at the politics of today and the division, and America has a divisive leader, and it's for others to decide if he's good or bad. But it speaks volumes, I think, to the strength of a liberal social democracy, that Trump is there because there is a collective sense that something's not right, like as you have expounded upon, something's not right. So there's an itch, and this democracy is itching. Has it got it right on the first time? Personally, I don't think so, but that's not for me to decide. And the great thing, however, is it's got the curiosity to recognize things ain't right, and it's had the courage to kind of fire a broken arrow, if you will, and give us Trump. And maybe we'll get Trump 2 and Trump 3, but maybe we'll find I'm pretty sure that at some point in the next 20 years, we'll find an iteration that's a lot better than anything the rest of the world will put up in opposition. And
Right.
so, but really, and this is a money-making exercise, this show, I want to say, on a Sunday. The chattering classes, the guys who are managing the huge pools of speculative capital, the big thing, and why the US markets have disconnected from what feels like real life, is simply that the dollar's presence at the center of the system and kind of the need for the dollar to trade lower means that because other sovereign nations will resist a weaker dollar by weakening their own currencies, that the only mechanism for them to do so is to print their fiat Swiss francs and their fiat euros. By fiat, I mean just these pieces of paper, these pieces of worthless yen, CNH yuan, okay? And with that, they have to buy American assets. So if you can imagine, at the end, if we are talking about perhaps this is the end of a hegemon, or it's the end of something, the ends are always dramatic. The end of the technology bubble at the end of the 1990s was a parabola.
Right.
And most people that I speak to in the speculative fields are kind of sensing, well, what if China and Europe and the Swiss and the Japanese, if the dollar's kind of gravitating to 80, the amount of money, the Swiss central bank owns Apple, it owns Amazon, it owns all those bank stocks, it's just, and I think it's front running. I think all of these central banks, and people come back and say, why would they do that? Why would they buy treasuries when they can buy gold? Yeah, I hear that all the time. That's a fundamental misunderstanding of what I'm saying. The fundamental desire for the central bank, which is the agent of the political government, is not to make money. And remember, they have zero cost. There is zero cost involved in printing a perpetual bond that we call quantitative easing. Zero cost, okay? You can't lose money if you have zero cost, okay? So they are simply the Swiss are buying Amazon to weaken their currency, not to strengthen. If they wanted to strengthen their currency, sure, they would buy gold, all right? So, and we talk about hyperinflation. Are we going to see the drama of what has befallen some of the cousins in south of the border, and what we see tragically in Venezuela, what we've seen elsewhere in the 1930s in Europe, in the 1920s with Germany. 1930s, we had Japan and China suffered dramatic hyperinflation. Hyperinflation, I think, is most unlikely, but were it to occur in our generation, again, it's going to happen with the one nation that turns Austrian and hard money and resists a weaker dollar, and it allows its currency to appreciate, and it's buying gold, because that, in terms of its economy, is going to crash, absolutely crash, and there will be a revolt like you saw in Germany after the First World War. And it's that angry social mood. It's not a monetary phenomenon. It's an angry social mood that generates the despair of those hyperinflationary moments.
But if their currency appreciated substantially, like you're talking about, there'd be winners and losers there. It wouldn't be.
Sure. Yeah. But that's when I get really, really, really inflamed, George, to cut you off. You're right. Winners and losers.
Because correct me if I'm wrong, but you're assuming that that it would be extremely detrimental because of the exports. Am I assuming that correctly?
It's extremely detrimental to the economy at large. Okay.
Let
me give you an example.
We're getting a lot cheaper goods, so the consumer would have a tailwind there, in the sense that especially with the United States, when they run these huge deficits, so they have to import to consume. And if those imports are getting a heck of a lot cheaper, then the prices of the stuff at Walmart, Target, Home Depot, those all go down. That's going to benefit the consumer. But am I seeing that right?
Well, you're seeing. Hey, it's not for me to pass judgment. I can only comment on my understanding, and my understanding. So the world suffered a deep, searing catastrophe in the 1930s, which and really the late 1920s, which was enormous adult unemployment in excess of 20%, and tremendous suffering. the suffering that comes from that is immense. And I allude that to, we had that because we had the ideology, the Austrian hard money ideology was the dominant force in central banking. And for currencies to adjust, you had to gain gold reserves. It was the high-powered money. If gold was being attracted and people wanted to park, or by necessity they had to send their gold to you because they were running trade deficits and you were running a trade surplus, the gold would come to you. With that gold, that would be kind of like a legitimate form of quantitative easing, that the banks would use that money and they would expand their balance sheets. And that's why we ended up having the roaring Wall Street 1920s, because the US success in running trade surpluses was attracting all of this high-powered credit to multiply and amplify what was already a strong economy. But the reverse of that was that in the countries that had no choice but to send gold to America, for the gold to come back, they had to compete on cost. And the principal cost in an economy, over 2/3 of all costs, is accounted for by you and me, by labor, by our wages. Okay, and so you've got a choice. In the 1920s, the choice was that you had to devalue the endeavors of your citizens. Your citizens had to work for less and less. They had to work more, and they had to work for less and less remuneration. And in the UK, we came so close to a communist kind of takeover and revolution, owing to the pressures that brought to bear on the economy. And that's why the UK was the first of the 37 members of the gold standard to pull away and say, you know what, the social mood is so dark that if we don't break away from this damn system which puts our citizens on a cross of penury, if we don't take our citizens down off that cross and start respecting them and just devalue this damn currency, it's finished. Who benefits, George? The people who benefit from the gold standard are the creditors. If you're a $5 billion family fund, well done you, because your endeavors, and I respect that. But you benefit because you're looking for safe custody. You want to put your $5 billion and you don't want to worry about the currency. That's what gold gave you.
Yeah, but the savers also benefit quite substantially as well. And I would argue that if you do, there's two different types of deflation. You know, there's a deflation that's caused from the destruction of the monetary supply, and then there's a deflation that's caused, or deflation, excuse me, that's caused from just productivity gains. And I think if you look at the late 1800s and you see the deflation that was a result of productivity gains with the gold standard in the United States, you see that you had this, let's call it 3% deflation. And I don't think that benefits any group greater than the poor and the middle class, because they don't have to speculate. They can keep making the same exact wage. You know, let's remember that nominal GDP in the United States during that time frame actually went up, so did nominal wages. So the prices of the stuff they buy on a day-to-day basis just gets lower and lower and lower. They're able to save more money, and the purchasing power of those savings increase. And you juxtapose that to when the Federal Reserve came into existence in 1913, and we've had a devaluation of the dollar by, let's call it 95+%. And what this does, if we have a 2% annualized inflation compounded, is it forces these same poor and middle class to take their savings that now is losing purchasing power and pushing it into financial assets where we have these boom and bust cycles, and every single time the beginning or the unsophisticated investor gets completely wiped out. So I want to get into some more questions, but I see what you're saying, that in certain situations, if you're not able to devalue the currency, that's going to come. The people that are going to have to burden that responsibility are going to be the workers, if let's call them the capitalists, or the employers, entrepreneurs, have a certain type of leverage. I don't know that they have that much leverage, but I want to be clear with people. I have only looked into the United States, and Hugh obviously has looked into it, not only in the United States, but how that affected different areas of the globe, like the UK and Europe. And I have not done that, and I need to get a more well-rounded view and maybe refine my own views. So I'm
Well,
definitely
George, I can
open.
say that
Yeah.
if we were having this conversation in 2010, 2011, I would have, my response would have been pretty close to, tacking with what your interpretation of that kind of golden disinflationary period at the end of the 19th century. Um, Further exploration for me, further examination, I came to reject that. I kind of just want to close out by, I just want to ask the question. I hope the audience, and if they're not, we'll return to it another time. But that period of disinflation that you refer to is captured. The period, the decade, the final decade, the 1890s, is captured by Frank Bohm's classic, The Wizard of Oz, which is a political allegory to it's an incantation for the desire to introduce a bimetal exchange system, monetary mechanism to the United States. The United States was simply run on gold, and the desire was that we would introduce silver, which was more plentiful in America, and in doing so, you would be easing monetary policy. I mean, the Wizard of Oz is a desire for a world of quantitative easing. The yellow brick road is gold. In the movie, Dorothy wears ruby slippers, but in the novel, she wore silver slippers. And you have, the evil witches of the East are the New York banks, and it's all about the proletariat and factories being closed by the tightness of money because there was not enough. Gold was not plentiful. This was before the introduction of cyanide, which allowed you to kind of leach gold out of South Africa and create a massive influx of high-powered money. And so the desire was to free the ordinary man. So whilst it seems noble, and you see the stock market went up and a lot of enterprise was very, very positive, believe me, the political allegory written in the 1890s was if you were hardworking, you were downtrodden. And that just seems to be a recurring theme, and it seems to be controlled by the ideology of men in suits who work for central banks.
Well, it's definitely an interesting take that I'm sure everyone can appreciate, regardless of what your opinion is on it, for sure. Yeah. Okay. So, and I want to dive into this in our interview. I want to make this about the Q&A, but it's really difficult to
Let's try and do really quick, snappy questions answers.
Yeah. Right. Yeah. Right. Well, I think people appreciate the long-winded, more in-depth answers. I know I sure do. Okay. Let's see. Okay, so here's another one for Hugh. Oh, wait. Here's Emil. Whoa, Emil, I just saw you. My buddy Emil Kalinowski was, did he have a question? No, I guess that's not really a question. Okay. So anyway, hi, Emil. Thanks for being on the live stream. It's good to see you there. Tell Jeff hi for me. Okay, here's another question. Oh, no, that gentleman or gal already asked a question. I'm going to try to mix it up.
Is that a meal with Jeff Snyder?
Yeah.
Well, if he's still on, I just great respect for the product you guys push out on the, is it Eurodollar University, whatever it's called?
Yeah, it's making sense Eurodollar University. So if you're not following Jeff and Emil there, make sure you do so. They're putting out just fantastic content, like Hugh says.
And to put it in context, that's something that I sit down with my notepad and I take notes, and then I steal all of their ideas.
Yes, so do I, exactly. Yeah, and also too, if you're not following Hugh on Twitter, make sure you do that, because obviously you heard the back and forth he has with just brilliant people like Richard Werner and Luke Groman, and you don't want to miss out on that at all. So make sure you're following Hugh. Okay. I'm getting so many.
Well, I should say, I'll let you go through that list, and I can tell everyone that's watching, I can testify to George's professionalism, because I invited him to a cocktail, a St. Mark's cocktail party, as you do last night. And George, being a super professional, came and was courteous and great company. But he declined my offer to go to a beach pop-up kind of disco. And so whilst I found myself at 3 a.m. drinking tequila and jumping up and down like a lunatic, I believe Mr. Gallman was tightly tucked up and sleeping.
Getting ready for today's live stream. That's right. That's right. Okay, let's see if here's a new. Okay, let's see. Oh, here's one. Okay, yeah. Raphael asks, I would like to hear from both. What's your vision about emerging markets moving forwards? He says, greetings from Brazil. So Hugh, what's your opinion on emerging markets?
I wish, I'm hesitating because I'm dismissive, not with discourtesy, but I think all of the action, just so that this system, I keep referring to the dollar global, you know, the center of the dollar being the center of the universe, and its demise is being speculated. It's been speculated forever, but it seems kind of relevant in a world where it seems so strange. And I'm just, again, just to paraphrase, I'll keep this short. I believe that the tendency will be for the dollar to be weaker. We may even see an extraordinary movement where the Treasury takes over and actually unilaterally expresses a desire for a weaker dollar, which is to say,
like a Plaza Accord 2.0.
And I would favor that, because I would say that the rest of the world is pimping the US. They've pimped the US for 100 years, and I don't see any gratitude, which is kind of part of my rage that you see on Twitter. Regardless of whether it's explicit or whether it's what we've seen in the last 2 months of this just gentle and visible slide lower in the dollar, I believe that puts immense pressure on the rest of the world to respond by buying American assets. And so there's a chance that the almighty movement that we've seen of late, for sure there'll be drawdowns, but I can imagine this market just taking off in an insane manner. Now, what I mean, I can see it going up like two and a half times and then halving and then going up 2.5 times. I can see it, the S&P taking on the kind of the footprint and the trail, the rocket trail of the NASDAQ between 1998 and 2000, simply because of the presence of price insensitive central banks. Again, they will want to weaken their currencies, therefore they will not want to buy sound investments. They will want to buy US treasuries, and they will want to buy liquid US equities, anything which will allow them to sell dollars and to sell their own over their appreciating currency. They have to sell that to bring it down to match the dollar movement. And the other side of that equation is they will just be parking and chasing US asset values higher. So
don't you think that's dependent on the country though, Hugh? Because if you're a country and you've got a lot of dollar denominated debt, and that's really a burden right now for you. If you see the DXY going down to 80, let's call it, that makes your life a heck of a lot easier. If you're one of these sovereigns that's got a lot of dollar denominated debt, or corporations where your cash flows, let's say, are in Colombian pesos, but you got $100 million with a dollar debt.
Yeah. But put it the other way. So these are the ones, those countries that you're referring to, those are the ones that at the first 10 days in March were selling every dollar asset that they had to try and bring down their dollar liabilities. Mm-hmm. So it kind of, the more that you can get them to correct for that, it would make the US markets have become almost like a volatility machine. When there is a hiccup, and my goodness, we had the mother of all hiccups, this grotesque virus, which heightened risk considerations. The first impulse, so this whole notion of the privilege, the unfair privileges and free benefits of being the reserve currency of the world. But one of the drawbacks is that whenever there's a credit issue, the first impulse by the rest of the world, especially those emerging markets, is to dump as much dollar assets as they can, which again is very pro-cyclical. If markets are going down, that really forces them down. So it's, the more we can take them out is a good thing. So, but I guess you could say, so emerging markets, it gives them emerging markets, the heyday of emerging markets really was that period up to the end of the 1990s. The 10 years up to 1997, Thailand had been the fastest growing economy in the world. And therefore attracted great capital. Again, capital is pro-cyclical. Capital doesn't go and look to mend and repair things. Capital just is greedy, and it's like your genes. It wants to survive. It wants to progenerate. It wants to multiply and get bigger and bigger.
Yeah.
But a weaker dollar would, I think, facilitate more generous provision of credit throughout the world. But I think the play in terms of I got liquidity, better liquidity vis-a-vis like trading in Colombia or trading in Vietnam, etc. And I can see a vector, I can see a thrust for more price appreciation in the US. But don't get me wrong, the US is going to have a huge, it's going to crater. It's going to crash, and then it's going to rise like crazy. It's going to crash, and it's going to rise like crazy. This is why I'm telling you, and this is why we've got to get Chris Cole on and work out how the trade for and I call myself I'm the ordinary Joe, right? I don't have Bloomberg, right? I sit in this sweaty island and I kind of think, but Chris is a real genius, and we've got to work out a means of how we can own volatility. Stocks are going to go shooting up, and volatility is going to go shooting up. Yeah. The most exciting thing for me intellectually this year has been that forward-looking VIX S&P volatility has remained elevated. So yes, cash volatility has come back to like 10 or 12, okay? But you can't buy that, right? You can only ever buy forward-looking volatility. And the forward-looking volatility for the month of September, October, November is still sitting there at 3 times cash. So that's telling you that smart people are going, something's in the mix.
Right. All right, cool. That's really got me thinking here. All right, let's go back to the questions. All right, here's an interesting one. I don't know if I've ever heard you talk about this, Hugh, but our mutual good buddy Jim Rogers talks about this all the time. So the question is, have either of you considered farmland as a way to allocate to commodities? Which countries' territories are you researching, and which food commodity do you believe are cheap currently? Did you ever invest in anything like that with your fund, or are you thinking about it now?
You bet I did. There was at one point, I want to say towards the end of 2007, my asset management business was responsible for one of the largest agricultural equity mutual funds in the world. We had almost $500 million invested. I don't get it. So I wanted to launch my hedge fund in 2002 because my kind of the craziness in my head, I was picking up kind of the REM processing that I wanted to be commodities, and commodities is a broad church, and the charts of wheat and corn and sugar and cocoa spoke as loudly to me as that of silver, gold, and copper. Right. However, what you see is not necessarily what you get, because there tends to be a very, like the shape of, I talked to you about volatility, and you can't buy cash volatility, and of course you can't buy. Well, you can, but you need a huge warehouse. You don't buy cash corn. You buy a financial contract for delivery in 3 months or longer. And there's typically quite a cost associated with that. It's a negative carry. I think you were alluding to how you advise friends and family to essentially have to own a cash generating, simple business that has a positive cash flow. And the agricultural commodities don't really offer that. That's why we elected to own the agricultural equities. So immediately you got a positive carry, and participation. Like gold miners move, and they move like 2x, the 3x the move in the underlying commodity. So I could never really justify the agricultural softs alone. And then, like we talked about your friend Chris, and don't give me 3 months, give me 20 years. in the context of commodities, give me 100 years. And it's not obvious. I mean, again, here I now sound like Warren Buffett's kind of poster boy, servant or whatever, but you know, investing for 77 years, if you'd put $1 million into the S&P, you'd have picked up a heck of a lot of duds. You got the average. Your $1 million today would be worth $5 billion. So, you know, I had my taste of agriculture. I kind of get it. I even still to this day own some agricultural land 100 miles outside London, but I'm not a great enthusiast. That's the one part of the 2002 me that I don't want to revisit. Yeah.
Do you think commodities are cheap right now?
Never liked that term cheap. Some things are cheap for a reason. You know, are they lowly? You know, a lot of things are lowly rated for good reason. I think in that context, agricultural land and agricultural futures, etc. They don't offer any. They don't engage. They don't. I'm not. They don't make me. They don't make me feel greedy.
Okay, so you're much more excited about gold, silver, and the miners than you are.
And also, I'd rather own a property in St. Bart's. I'm not being facetious, but I'd actually rather own a property in St. Bart's than 1,000 acres of Canadian agricultural land in Canada or indeed Uruguay. I spent a lot of time in Uruguay. I was almost going to buy a seat at the local stock exchange. I visited there and really got tightly involved. You know, Uruguay is kind of like it's not quite the Switzerland of South America, but it's where all it's the safe port for Argentinian wealth. Buenos Aires, you know, you just cross the border. But I didn't.
All right, let's get to another question here. We'll kind of get things wrapped up.
And as you find that question, sorry, I should say, so for me, I get a property in St. Bart's. I get 1 acre as opposed to 1,000 acres. It probably costs me the same amount of money. But you know, I get a unique piece of land, and plus the properties, they're making it harder and harder to make them. So it's almost like Bitcoin, where you've got the mining thing, and then you're kind of ultimately reducing the quantity that you're going to mine, and kind of that is St. Bart's.
Yeah, that is a good way to look at it. I didn't think about that. Hugh and I went out and looked at a couple properties the other day, just because as everyone knows, I'm kind of a real estate guy, and I was just giving my opinion for what it was worth. And yeah, it's definitely, you're on a little teeny island where everyone right now wants to come. I mean, going back to that cocktail party that Hugh and I went to last night, I can't tell you how many Americans are down here because they want to go long volatility with their own personal presence. They're seeing what's going on in the United States or other developed countries, or with the lockdowns and everything else. They're like, listen, I don't want any part of this. I want life short. I want to have some sense of freedom, and I don't want to be in the firing line, so to speak. And they're coming here. I mean, I'm not the only person with this idea. There's a lot of other people like that, and a lot of extremely wealthy people. And whether it's right or not wrong, it is what it is, that people with resources have the ability to come to small islands like this in a time of chaos, and they look for properties to rent. And if you're only on a little teeny island, it's just like having 21 million Bitcoin, and that's it. And it just gets small. The pie gets smaller and smaller and smaller and smaller. And if you own a piece of that, it's a lot more scarce, I guess, and easier to manage potentially than 1,000 acres of farmland at the same entry point. Yeah, and much more easy to control as well, I would argue. Yeah,
the other thing with the agriculture is that, you know, we have, thank God, but our civilization has constantly disproven the fearful prognosis of, heavens, what was his name?
Malthusian.
Yeah, that we would run out of food with, you know, we have a population today of what, 8 billion people, but you know, but it is really just government incompetence that we have people like starving, and so the ingenuity of the human mind has been up to the challenge, and the supply expansion has been extraordinary. And why should it not continue? And I think largely it's the ingenuity of mankind which you're betting against when you're buying agricultural property. That's a kind of contentious thing to say, but let's kind of write that down and revisit that maybe in a week's time.
Yeah. Okay, great. Let's get one or two more here. Oh, well, here's a question I'd actually interested in, and I think I probably know the answer, but I'd like to hear it from you, Hugh. Hugh's been here on the island on and off, I think, for over 15 years. Hugh, if I'm remember that correctly.
Yeah.
So this is, I'm sure you understand this well. Brandon asks, what's the political risk for St. Bart's? Isn't it sort of a hybrid French self-governed entity?
It is, if anyone's familiar with the United Kingdom, it's a bit like not the Channel Islands, but the Isle of Man, which is to be found further north and closer to Liverpool. And it has its own kind of independent constitution, but kind of seems to, at the margin, trade under the kind of security blanket or umbrella of the United Kingdom. It is not without, you cannot eliminate risks. And it's the advantages that it affords are not easy to attain. You know, I've spent 5 years kind of trying to squeeze my way through the thin pipes and plumbing of the matrix to get to the other side. And you know, I'm here, and I'm not gloating about it, but I feel like I paid a lifetime's worth of tax, and the capital that I earned, I only got it again after having to pay the man and to pay the capital gains tax. And so my property investments here are, I'm not looking for a silent partner in terms of the United Kingdom government. Right. And it's not been easy, but I have, you know, secured a kind of zero tax status on this island. Things change, I have to be vigilant about that, but the joy of this place is it's not the Caribbean. I met a Belgian lady on the beach yesterday. She said, "I hate this place. Zut alors, I hate it." And I'm like, and you know, so she was looking. She wanted, villages, and she wanted like out of Africa kind of experience. That's
more rustic type thing.
St. Bart's is the south of France. It's the might of the European project in a tropical climate.
Yeah, I totally agree. Yeah, I don't think you got a lot of like zero political risk here. There's a lot of red tape, I think, if you want to build a property. So you got to be an insider like Hugh, but I don't think there's a lot of what most would consider political risk. Okay, I think we're going to wrap it up there, Hugh. I really appreciate you coming on, and I'm sure everyone really got a kick out of seeing you on the live stream. And thank you for your hospitality. Let me come to your gorgeous place, or one of your gorgeous places here, right next to the ocean. And for anyone that wants to find out more about what you're doing on social media, I know you're working on a podcast. You got your Twitter account. You got tons of stuff going on. How can they find more? How can they find out more about your content and what you're doing online?
Well, for the moment, we're using this Hugh Hendry official banner. I hope in about 2 weeks' time, we're going to be launching my own website. It'll just be hughhendry.com, make things a lot easier. We now have the YouTube page, which is Hendry Official, and you will see these kind of video vlogs of the podcast. If you just want to listen to the podcast, just type my name. It's on Spotify or iTunes. It's called the Confession Series. And then I'm more and more engaged in trying to put kind of thought bubbles out there on Twitter. And then I kind of like to react and kind of see what people like in terms of where there's a feedback which resonates with people. And then we try and kind of take that little commentary and then marry it with a kind of provocative image and then push it out onto Instagram. So I find it fun. And I hope I hope others will find it a little bit stimulating and could join me in that endeavor.
Yeah, they definitely will. Tons of value there, guys. So definitely follow Hugh on those social media outlets. So I think we're going to end it there. For those of the people on the feed right now that are Rebel Capitalist Pro members, keep in mind I'm going to do a live stream here in about 45, 50 minutes for you. So make sure you go on there. It'll be just myself there answering questions. And for those of you who want to find out more about Rebel Capitalist Pro, what I do with Lynn Alden and Chris McIntosh, go to georgegammon.com/pro. And let me go over to back to the chat. I just want to give out some shout outs here for the people who are awesome enough to stay till the end. We've still got almost 1,100 people on the live stream, Hugh. Just
and, and for those people, George, if there's anything I've said which like really was gnarly, or if they feel that they really wanted to push something my way, you know, the @Hendry_Hugh, I'll see it, and you know,
on Twitter,
on Twitter, and if it's juicy, I'll come back.
All right, great. So I want to give a shout out to Nicholas, to Jim, Magic Man, Aaron, Emily, Eric, Aaron, Caleb, Donald, David, Arthur, Brendan, Ricardo, Taco Negro. He's here every single week. Wim, Jim, Milton Friedman is here. Hugh, my goodness. Oh, and there's Gene. Gene, thanks for being on the live stream, buddy. Eric, Gigi Clips, Donald, Logan, Tatiana, Dickie Dunn, Anomalia, I know she's here all the time. Charlie, Arthur. All right, guys, I appreciate it. And I will see you on the next video.